Ever find yourself worrying about when to invest your money to get the best possible return? Well, have you heard about the investment strategy known as dollar cost averaging? You might just find it's the game changer you've been looking for. Welcome back to our channel. In today's video, we're going to dive deep into the concept of dollar cost averaging, or DCA. Get ready to dive headfirst into the magical world of dollar cost averaging, where ordinary people become extraordinary millionaires. This strategy may be the answer to your investment dilemmas. By the end of this video, you will know what DCA is, its benefits, and how you can use it to invest in assets like the S&P 500. If you found this video to be enlightening and you're eager to break free from the clutches, go ahead and give that thumbs up button a quick tap and consider subscribing to our channel, as it greatly helps us in delivering more valuable content similar to this. Dollar cost averaging. So, get ready to ride the waves of financial success without breaking a sweat. Forget about complex investment schemes or wearing a suit made of dollar bills. This method is as straightforward as it gets. Let's take a more in-depth look at what dollar cost averaging really entails. As mentioned earlier, DCA is an investment technique that involves consistently investing a fixed dollar amount into a particular asset, regardless of its share price at any given time. Now let's break down this definition for a deeper understanding. The keyword here is fixed dollar amount. This refers to the amount of money you choose to invest each time. The important thing to remember is that this amount stays the same, regardless of the asset's price. So whether you're investing $100 or $1,000 per investment period, that amount doesn't change based on the price of the asset. If you think about it, it's akin to a subscription service where you pay the same amount each month, regardless of how much you use the service. The regular schedule is another critical aspect of DCA. This is the time frame you decide to make your investment, and it could be monthly, quarterly, or any period that suits you. The regularity takes the guesswork out of when to invest, providing a disciplined and systematic approach to investing. This approach helps you stay committed to your investment plan and prevents you from making impulsive decisions based on market trends or news. Now, let's talk about the share price and how it relates to DCA. As per the strategy, you buy more shares when the price is low and fewer shares when the price is high. This method may be counterintuitive to some, but it's all about minimizing risk and avoiding the common pitfall of buying high and selling low. The average cost per share over time, hence the name dollar cost averaging, will likely be less volatile than the market price. This process reduces the risk of making a substantial investment in an asset just before a sudden drop in price. DCA is not about making a quick buck. Instead, it's about consistent, long-term investment. The goal isn't to get rich overnight, but to build wealth gradually over time, reducing the potential for significant losses along the way. It is a more cautious approach to investing that aims to smooth out the peaks and troughs of market volatility. It's important to note that while DCA provides a disciplined approach to investing, it does not entirely eliminate risk. Like all investment strategies, there's always a chance you could lose your money. But what DCA does offer is a mechanism to mitigate the risk by spreading out your investment over time, thereby potentially reducing the impact of a sudden market downturn on your portfolio. Benefits of dollar cost averaging. Now that we've delved deep into what dollar cost averaging is, it's time to explore the benefits that make this strategy a popular choice for many investors. One of the most significant advantages of DCA is that it helps to eliminate the emotional aspect of investing. Emotion-driven decision-making can lead to risky behavior, such as buying high out of fear of missing out or selling low during a market downturn due to panic. But with DCA, because you're investing a fixed amount at regular intervals, these emotional decisions are taken out of the equation. Regardless of whether the market is bullish or bearish, you continue to invest the same amount. The consistency of this approach helps you keep your investment plan on track, irrespective of short-term market noise. Another considerable benefit of DCA is the ability to reduce the risk of poor market timing. If you invest a lump sum into a particular asset and its value plummets shortly after, you would incur a significant loss. But with DCA, your investments are spread out, so even if the market drops right after one of your investment dates, only a portion of your total investment is affected. By spreading out your investments, you're also spreading out your risk, making DCA an effective risk management strategy. This brings us to another important aspect of dollar cost averaging. It capitalizes on market downturns. Since DCA involves buying more shares when the price is low and fewer when the price is high, a falling market means you're accumulating more shares for your fixed dollar amount. So, paradoxically, a failing market could work in your favor, as it allows you to buy a larger quantity of the asset at a lower cost, potentially leading to greater returns if and when the market rebounds. Additionally, DCA encourages financial discipline and promotes regular saving. Since the strategy involves committing to invest a specific amount at regular intervals, it inherently encourages a consistent saving habit. It allows you to build your investment portfolio gradually over time instead of needing a significant lump sum to get started. DCA can also be particularly beneficial for novice investors. The strategy's simplicity makes it easy to understand and follow. Plus, it removes the need for continuous active management and decision-making, which can be daunting and time-consuming for less experienced investors. It is a way to participate in investing without requiring expert knowledge or substantial time commitment. While it's clear that dollar-cost averaging has several benefits, it's also important to note that it's not a one-size-fits-all solution. Every investment strategy, including DCA, has its own set of potential drawbacks and limitations. It's crucial to understand these and to consider your personal circumstances, financial goals, and risk tolerance before deciding whether DCA is right for you. Speaking of financial goals and risk tolerance, if you're still a beginner to investing or want to learn the basic strategies in investing, we have a video to teach you the basics. Just check the description box for the link. Buying into the S&P 500 with dollar-cost averaging. Now that we've explored dollar-cost averaging and its benefits, let's shift gears and explore a practical application of this investment strategy, buying into the S&P 500 index. The S&P 500, or the Standard & Poor's 500, is an index of 500 of the largest U.S. publicly traded companies. It's often used as a benchmark for the overall U.S. stock market's performance because it represents a broad cross-section of the economy. Using DCA to invest in the S&P 500 can offer several potential benefits. First, investing in the S&P 500 offers diversified exposure to a wide range of sectors in the U.S. economy. This diversification can reduce the impact of any single company or sector performing poorly, thereby helping to mitigate risk. Second, the S&P 500 has historically provided positive long-term returns. Though past performance is not a guarantee of future results, the index has generally trended upwards over extended periods. Using DCA in this context allows you to potentially capitalize on this long-term growth trend while mitigating short-term volatility risk. So how does one apply dollar-cost averaging to invest in the S&P 500? Well, the principle remains the same as with any other asset. You could invest a fixed dollar amount in an S&P 500 index fund or ETF at regular intervals, regardless of the price of the fund at each interval. One way to implement this would be through a retirement savings account like a 401k or an IRA that allows for regular contributions to be invested in an S&P 500 fund. Many such accounts allow automatic contributions, which align perfectly with the DCA strategy's regular investment schedule. By doing this, you would be purchasing more units of the index fund when prices are low during market downturns and fewer units when prices are high. Over time, this strategy could result in a lower average cost per unit compared to investing a lump sum at a single point in time. It's also worth noting that employing DCA with the S&P 500 reduces the need for continual market analysis and decision-making. Since the S&P 500 is a broad market index, you're essentially betting on the overall market rather than trying to pick individual winners. This strategy can be particularly beneficial for those who don't have the time or expertise for active investment management. However, as with any investment strategy, DCA with the S&P 500 isn't without potential drawbacks. For one, although the S&P 500 has historically trended upwards, there is always the risk of prolonged market downturns or even crashes. Moreover, DCA might not optimize returns in steadily rising markets compared to investing in a lump sum. If you're finding this video informative, remember to give this video a like. Your likes and shares really help our content reach more people. Advantages of dollar-cost averaging. Let's now discuss overall advantages of this investment strategy. Reduces market timing risk. One of the most significant advantages of dollar-cost averaging is that it reduces the risk of poor timing. When you invest a lump sum, you could potentially enter the market at a peak, which can lead to immediate losses if the market subsequently declines. DCA mitigates that risk by spreading investments over time, reducing the impact of short-term market fluctuations on your overall portfolio. Capitalizes on market volatility. Another advantage of DCA is that it can turn market volatility into an opportunity rather than a risk. During periods of market decline, your fixed regular investment buys more units of an asset. This means you accumulate more assets when prices are low, which can lead to significant gains when the market recovers. Promotes financial discipline. Dollar-cost averaging also encourages financial discipline by necessitating regular investment contributions. It's a methodical strategy that helps inculcate good financial habits, including regular saving and consistent investing, which are crucial to building long-term wealth. Simplifies investing. DCA simplifies the investment process. With DCA, you don't need to constantly monitor the markets or make frequent buying and selling decisions. Instead, you set a fixed amount to invest at regular intervals and then stick to that schedule, irrespective of market conditions. Accessibility. DCA is a highly accessible investment strategy. It doesn't require large lump sums to get started, making it an approachable option for those who might not have a lot of capital to invest initially but can commit to regular smaller contributions. Potentially lower average cost. Over time, dollar cost averaging can potentially lead to a lower average cost per share compared to a lump sum investment made at a single point in time. This is because DCA allows for more units to be purchased when prices are low, thus potentially reducing the average cost over time. While these advantages make dollar cost averaging an effective strategy, it's important to remember that no investment strategy is without risk. DCA won't necessarily yield superior results in all market conditions. In steadily rising markets, for example, a lump sum investment might outperform DCA. Additionally, while DCA reduces the risk of poor timing, it does not eliminate it. If your first few DCA investments happen to coincide with a market peak, your portfolio could suffer initial losses. Despite these potential limitations, the overall advantages of dollar cost averaging make it a strategy worth considering for many investors, particularly those who prefer a disciplined, long-term approach to investing. The potential disadvantages of dollar cost averaging. Now that we've gone through the potential advantages of dollar cost averaging, it's only fair that we take a closer look at some potential drawbacks of this investment strategy as well. Missed opportunities in rising markets. While DCA can help mitigate the impact of market downturns, it can also lead to missed opportunities in rising markets. If the market is consistently going up, you could potentially achieve higher returns if you invested a lump sum early on, rather than spreading out your investments over time. Not a substitute for research. It's essential to remember that dollar cost averaging isn't a substitute for thorough research and careful investment selection. Even when using DCA, you need to carefully select the assets you're investing in. If you consistently invest in an asset that's performing poorly, DCA will simply result in consistent losses. Transaction costs. Depending on your broker or platform, each investment made using the DCA strategy might incur transaction fees. If you're investing small amounts frequently, these costs could eat into your returns over time. However, many modern investment platforms offer low-cost or commission-free trades, which could mitigate this issue. Needs consistent cash flow. DCA requires a consistent cash flow, as it involves investing a fixed amount regularly. If your income is unpredictable or you don't have a sufficient emergency fund, you might find it challenging to commit to regular investments. If there's a chance you might need to access your investment money in the short term, DCA might not be the best strategy for you. Dollar cost averaging can be a powerful tool in your investment arsenal. It offers a disciplined, long-term strategy that takes the stress out of timing the market. However, as with all investment strategies, it's important to understand the potential drawbacks and ensure it aligns with your investment goals and risk tolerance. If you've learned something new today and enjoyed the content, please don't forget to give this video a like as an appreciation for our effort. This means a lot for us, and share it with your friends who might also find this information useful. You can explore other videos shown on the screen. Thank you for watching.